What is going on, investors? Hopefully you guys have had a great week out there. Time to do something a little bit different here on the show. We're going to do kind of a rapid fire where we cover as many companies as we possibly can in one video. Now, if you're familiar with our channel, every earnings season and basically almost every month, we cover companies, we look at their financials, we look at the stock chart and things like that. And we've obviously been doing that over the last few weeks as we are in the midst of earnings season. Now, I'm not able to get to every single company, so I'm going to try to squeeze as many companies as I can here in one video. Now, the good news for you is down in the comments, the first pinned comment and the description down below, I'll include timestamps to all the companies that I will go over. So if there's one that interests you and ones that don't, you can kind of bounce around. You don't have to watch the whole video. Now, first company we're going to cover today is Snap Incorporated, ticker symbol SNAP, better known as Snapchat. This stock is up about 300% over the last year. Hello, got a $95 billion market cap. They just reported earnings in their first quarter. Now, what was interesting is the stock sold off about 6% in the after hours after reporting these earnings, but during the session after reporting earnings, the stock was actually up 9%. So as investors kind of digested the news and the guidance, they actually were pretty happy about it. Now, they came in with a little bit of light profitability guidance. When we get over the numbers with Snapchat, we'll actually see a little evidence of that, okay? Now, the other thing that they announced is this mixed shelf offering, which is basically like a fundraising round where they probably will issue common stock, preferred shares, or maybe even debt securities or warrants to raise some money for the stock. Now, it doesn't determine an amount. They haven't really followed through with this 100%, but it is interesting that Snapchat's looking to raise some money. It'll be interesting to see what they do with this money because when we look at the balance sheet at Snapchat, there's like nothing there. So it's interesting that they are looking to raise money. Obviously, this is a company that loses money, so it could be for that purposes, but it could be for some kind of acquisition or something like that, and that could have helped propel this stock up the following day. Now, one thing I do want to show you is I've got a price to sales. I figure price to sales is pretty easy since not all these companies make money, but they all make money the same way. They basically sell online advertisements, and I've got Snapchat here, that's the orange line. I've got Facebook, the blue line. I've got Pinterest, which is a pink line, and I got Twitter, which is a green line. And we see here, Snapchat actually trades at basically 37 times sales, whereas Facebook trades at about 9 times sales. Pinterest is at 28 times sales, and Twitter's at about 13 times sales. So again, not necessarily something that I would look at all the time, but Snapchat and Pinterest, to be specific, are very, very overpriced in terms of a price to sales basis when you compare them to the market behemoth that is Facebook. Now, let's jump over to the numbers here. We've got 3 months ended here for Snapchat, 19/20. We've got the full year, 19/20 here as well. We see here we almost cracked that $1 billion revenue, so that's really strong. I think investors probably excited about that. You see in the previous year, they were at, I don't want to say only, but they were at only 560 million. Now they're all the way up to $1 billion. So this is a company that's growing very, very quickly from the revenue side. We see for the 12 months, I mean, this was just a phenomenal quarter. They're obviously accelerating whatever they're doing with the ad business and things like that on Snapchat. They're obviously accelerating that because we went from 1.7 up to 2.5. You annualize out this 9 billion, maybe push it to $1 billion, and all of a sudden you're at like $3 or $4 billion for Snapchat in revenue, and they did 2.5 in the year. So it's a company that's growing their revenues very, very quickly. That's indicative of maybe why investors are paying more for these types of revenues. Now, not the full story. We got to pay some cost of revenue, but super high margin. Okay, we spent $385 to make $911. Okay, but we do have R&D, sales and marketing, and some general administrative. Our total cost of expenses came in at $1 billion, almost on the number. Again, we came in just shy of that on the revenue side, but it does look like it's starting to scale a little bit, in my opinion, okay? Our general administrative actually went down. We went from 215 down to 146. That's probably a good sign. These other ones, not necessarily research and development, but you'd like to see some of these other ones flatten out, and it appears that is exactly what happened, because we actually spent $814 2019 in the previous year. That is, I want to say that's only going up about $200 million. And again, we went up about $400 million on the revenue side. We see for the full year, we went from $2.8 billion in expenses up to $3.3 billion. So not bad. They're scaling there. Now, we do have an operating loss here. We lost about $100 million in the last 3 months. But look, the previous year we lost $253 million. So we basically cut that more than in half. And for the full year, we had $1.1 billion in 2019. That's how much money they lost. And in 2020, this year, they lost $862 million. You see, if they can repeat this 900, we'd be actually cut in half, and we'd be losing about $400 million for a whole year. So Snapchat's got things moving in the right direction, in my opinion, from kind of an expense side. Now, let's come over to the balance sheet. Let's see, why are they raising money? And again, if you look at this balance sheet, we've got December 31st, 2020, so this is the most recent. We've got about $2.5 billion in cash, and then they've got another about $744 in receivables. That gives us about, in total current assets, about a little over $3 billion. Okay, that compares favorably basically to everything that we have on record here. Now, total liabilities are basically flat quarter over quarter. In fact, they're down just a little bit. We're at $2.7 billion in liabilities. So nothing really that too concerning here. We do have this convertible note sitting on the balance sheet as well. But other than that, this company looks financially healthy to me. So it'll be interesting to see what they decide to use this money for. And maybe it could help propel the stock even higher. Now, not that it needs any help. We come over here to the stock chart. This stock has been roaring, okay? I mean, it was like a $30 stock just a couple months ago, and now it's at about $65 per share. I see some sideways consolidation that we made between $50 and $54 per share. If for some reason this massive uptick that we've made over the last day or so in Snapchat, if we were to pull back, the first spot where it would be kind of nice to buy shares would be $55 per share. You should see some support if this stock sells off for whatever reason. Again, momentum sometimes rules the roost. When it comes to the stock market, this stock could just keep rolling up ahead. The other thing that you could potentially see as well is we start another sideways channel up here with Snapchat, maybe somewhere in this range here, where we're from about $56 per share up to $65. If we sideways consolidate with Snapchat in that region, again, it might be a buying opportunity as well. I don't see a whole lot on this stock chart that makes me want to just fall in love and go out and buy tomorrow, but this stock is a good performer, and if we do see some sideways consolidation and you do like the name, you do like the growth, and you don't mind paying a little bit more than you are at Facebook and maybe even Twitter, then Snapchat could be an investment for you. So hopefully you enjoyed this one. Next company we're going to take a look at is Pinterest, ticker symbol PINS. This stock is up 275% over the last year. We're going to jump into the quarter. It was a phenomenal quarter from a lot of different angles. I think you're going to want to stick around and take a look at these numbers. Now, from a user growth perspective, they were up 37%. They 76% revenue growth. This stock really popped after these earnings. We'll also take a look at the stock chart. If this thing happens to pull back, there's a couple levels where I think this could be a strong buy. Now, one thing that you want to be aware of is with Pinterest, you are paying a premium. So I've got price to sales up here for Snapchat, Facebook, Pinterest, Twitter. All these companies make money the exact same way. They sell online advertisements, okay? Some of them make money, some of them don't. But we see here Pinterest in this purple line is trading at about 29 times sales. Facebook's at 9 times sales. Twitter's at 13 times sales, and Snapchat, which is maybe a little bit more comparable from Pinterest from a business level, is at 37 times sales. So investors are really paying up for Pinterest sales. When we get over them, I'll show you possibly why they're willing to do that. Now, first slide I want to show you here is we see here our revenue growth in the quarter up 76%. For the whole year, it was up 48%. So it was just a great quarter, okay? When your whole year is up 48%, but the quarter 76%, it was a phenomenal quarter. We see revenue here in the United States. I love how they break things out here with Pinterest. 67%, great quarter considering for the whole year we're up 40%. And the revenue for international up 145%. That's for the whole year, we were at about 130. Now, not the full story. Interesting stuff here. We got MAUs, which is monthly active users. For globally, we're up 37%. That's basically for the whole year as well. We see here for the quarter, we were up 11% here in the United States. So I don't want to say they're peaking out, but Pinterest is a far more mature product here in the United States, because when you see globally here in the international market, they're growing at 46% in terms of monthly active users. A lot of runway for growth likely ahead in that international segment. Now, here's what you also want to take a look at is ARPU, which is average revenue per user. We see globally it's $122 up to $1.57. This is per user. Here in the United States, this is really impressive. You go from $4 per user all the way up to about almost $6 per user. That's 49% growth in the quarter. You see for the whole year, we were only up 27%. So they really accelerated it here in the quarter. Got a lot of advertisers on board. But here's the exciting thing. I told you that their monthly active users are really accelerating internationally at 46% growth. Again, compared to 11% growth in the United States. So you want to see this ARPU and international continue to accelerate. And yes, it did. Up 67%. Look at the delta between the international ARPU and the United States. Take a look. We're at 35 cents per user internationally, $6 here in the United States. So obviously, I don't necessarily think international will ever catch up to the United States in terms of this ARPU. It's just a different market, a lot of different markets out there, but you would anticipate this to continue to go up. 35 cents per user. It makes me want to advertise to some of those people. Now, 3 months ended here, and we've got our year ended here, 19 over 20. Like I said, it was just a phenomenal quarter. We went from $400 million in revenue in 19 all the way up to $705 million. It was just a great quarter. Now, not the full story. It actually gets more exciting than that. So we've got our cost of revenue, research and development, sales and marketing, and G&A cost. You see here that our cost of revenue went up a little bit. You'd expect that when you have this type of revenue growth. But look at this. Research and development basically flat, sales and marketing actually down, general administrative up a little bit, but not bad. Here's our total costs and expenses. We're at $444 in the previous 3-month period, only up to $500 million. You see here for the full year, we spent $2.5 billion last year in 19. This year we spent 1.8. That's a pretty big drop. Take a look at this. Income from operations in the fourth quarter was $205 million. Quite frankly, I'm curious why this stock isn't up even higher than this, because you annualize out this 200 million mark and tack on a little bit of growth, and all of a sudden you're at $1 billion for operating income for Pinterest, which would put it in rarefied air, in my opinion, in terms of social media stocks out there. It flowed all the way through to the net income side. You see here we earned 30 cents diluted. We lost 6 cents in the previous quarter. And look at this. We lost 22 cents for the year. So if they can continue this momentum, keep these costs in check, keep these revenues growing like this, hello, Pinterest is a phenomenal investment in my opinion. Now, let's take a look at the stock chart. Now, the stock has run away from us. I mean, it's pulled forward a ton of gains here. You know, some of this stuff, there might have been some insider knowledge on this because this stock has just been running and then it had a nice little pop. Now, it's pulled back a little bit. There's a couple areas. If this one pulls back into this consolidation area here, the first stop is probably somewhere closer in here. We can say, maybe just bump this up to $72, which is about $9 lower than where the stock is today. $68 is another level on a pullback, and 64 would be one where I would probably be aggressive, because you see here it acted as pretty significant support here, resistance here, support here, and it was like the launching pad here. Any pullback into that 64, 65, even 66, anywhere between 64 and 68, I'd probably be a little bit more aggressive with my sizing on my orders with Pinterest, okay? That's on a pullback. If the momentum just continues up on this one, you likely will see some sideways consolidation at some point up here in this, you call it $80 to even $90 per share range. Any sideways consolidation in there would maybe be worth it, because I tell you what, if they can repeat this fourth quarter, I don't know if they're going to be able to do that. If they're going to be, can they repeat this? Okay. It was a great quarter from a revenue growth perspective. I think they're going to be able to, okay, because you still have really low ARPU here in the international market. The United States is still growing, and you still have solid user growth. I think this is a company that's going to keep this momentum going. This is why investors are willing to pay up for the price to sales. But I wouldn't blame any of you guys out there that's seen as this company is overvalued, or maybe you just rather go with Facebook or something like that. So that was Pinterest. Hopefully you guys enjoyed this one. Next company we're going to take a look at is McDonald's Corporation, ticker symbol MCD. Such an iconic stock and company. I really should add this one to the regular rotation. If you'd like to see that, maybe leave me a comment down below. So McDonald's is really good because they pay this $5.16 per share dividend. That's good for about 2.43%. But over the last year, the stock is basically flat. We had this big drop in March. The stock went down to about 150. So if you caught it there, you got some nice price appreciation. But over the last year, not great performance. But over the last 5 years, this stock is up 84%. Now, from a price to earnings basis, because McDonald's just churns out that cash or churns out that earnings, I think you can look at this one from a price to earnings basis. Some of these tech companies that we analyze here on the channel and kind of pre-profit companies can't really do this, but McDonald's you can. And we see here they're trading at about 33 times earnings right now, and that is near a 5-year high. It's been as high as about 35 earlier this year. Now, I see here on this graph, this stock likes to be in this $25 times range price to sales. So if you want to wait for a pullback, if you want to use PE ratio as one of your indicators on when to buy McDonald's, I'd wait for the price to earnings to get closer to that $25 level. Now let's jump over to the earnings. These are our quarter ended. I'm going to look at quarter ended and year end with McDonald's because I think you'll see something there. It's kind of interesting. So we've got revenues here on this top line. Again, this is quarter over year on a quarterly basis. And so we see here our total revenues came in basically flat, down 2%, okay? They went from we'll call that 5.4 down to 5.3. Now let's see what happened to our expenses. So we got total operating costs and expenses down here. Those basically were flat. They were 3.135 and they ticked up just slightly to 3.17. Again, pretty admirable considering everything that's going on with the PPP and things that they need to do for their employees and the customers at McDonald's. Interesting that they were able to hold that flat, but basically kind of a flattish quarter when, we still got shutdowns in certain parts of the country. Obviously, McDonald's got drive-through and things like that. Now, they earned $1.84 per share. That compares a little bit negatively to the previous year where they earned $2.08. That's down about 12%. Now, the reason why I showed you the quarterly earnings is, we've got this 2% decline. We've got 1% increase on this expenses, 12% on the earnings per share. I want to come down here now. This is for the full year. And so we've got year over year, 19 over 20. Paints a little bit different story. And so it shows you, here's what it's going to show you, is that maybe McDonald's is starting to turn the corner, like a lot of companies are, because you see here for the full year, we were actually down 10% on our revenues. We went from 21.4 down to 19.2. Again, on the quarter, we were down just fractionally. For the full year, we're down 10%. Now we see total operating costs and expenses. They actually did an amazing job here, actually reducing these by 3%. Obviously, maybe some workforce stuff, and you got revenues down this much, and you might even had some McDonald's even close or be unoperable, but pretty nice to go from 12.3 down to 11.8. They probably had to put up a lot of plastic screens and get masks for employees and things like that. So to keep cost in check like that, very nice. Now, from an earnings per share, look at this. We were down 20% in the year, but we still churned out big time money. Okay. $4.7 billion net income in the year. That compares, again, relatively unfavorably, though, to the previous year where we churned out $6 billion. But just a very, very strong company. Now, when we take a look at the balance sheet, everything looks pretty darn good. Okay, they've got this large cash balance, 3.5. That compares, that's way over. They had under $1 billion. They run things relatively lean here at McDonald's. They serve fattening food, but they run the balance sheet pretty lean. Okay, $3.5 billion for this large of a company is not that big. Now, they do have quite a bit of debt here. They have $35 billion. That ticked up just about $1 billion over the the last year, but at the interest rates McDonald's is going to borrow at, not too big of a deal. I want to look at cash flows really quick. Let's see. They did pay these dividends again this year, so those ticked up just a little bit, but everything else looking really solid in terms of cash flows. Cash provided by the operating activities, take a look, down to $6.2 billion. In the previous year, it was $8 billion. So again, kind of one of those years, kind of a holding pattern for McDonald's in terms of its cash flows, in terms of its profits. Can you get this stock at a discount? I tell you what, I pulled up the chart. I'm actually on a weekly view of MCD right now. I didn't really see any really defined trend lines, honestly, but what I did notice is this stock tends to go on runs and then kind of consolidates downwards and then goes on a run again, consolidates downwards, goes on a run. This was the March of more sell-off than consolidation, but now we're on a run and we're consolidating down again. And so what this means to me is at some point, McDonald's going to run out of consolidation and it's probably going to retest these highs. I would guess back up into the 230 range, at least probably back up into the 225 range. So McDonald's, in my opinion, kind of a long-term holding stock, but it has this setup. I mean, this goes back to 2018 because I'm on a weekly view here. So I've got 1, 2, 3, 4, 5, like 5 different times where this stock is just proven really predictable. Obviously, this big March thing was kind of unpredictable, but everything else just dead on with McDonald's here. So I kind of like the setup from a chart perspective. From a valuation perspective, I'd probably wait for a deeper pullback if that is possible. But if you're a buy and hold investor and you're holding with this 2.4% yield, you kind of inch into this one, maybe get it on pullbacks, keep your yield up over 2%. It's not a bad buy and hold stock in my opinion. So that's McDonald's. Interesting company. It'll be interesting to see how they do in the new year, see if they can get some momentum behind their products and get some momentum behind the reopening and maybe make even more money in the next year. Next company we're going to take a look at is Lockheed Martin Corporation. This one's super interesting, ticker symbol LMT. This stock is down 22% over the last year. We do get a nice little 3% dividend on this one. Better believe the United States government would never, ever let a company like this go under. So keep that in mind when we're talking about this one. The other thing I want you to keep in mind is when we get over the stock chart, this stock is really, really signaling a buy in my opinion. So that should be exciting to you if you want to go long Lockheed Martin. Let's explain some other reasons why you might want to go long this one. Take a look. We've got a 3-year price to earnings graph here. We're sitting at about 13 times forward PE. And take a look, or this is trailing 12 months PE. We are basically on a 3-year low in terms of trailing 12 months PE ratio with Lockheed Martin. So you're getting it, in my opinion, at a pretty good price from a price to earnings basis. Now let's jump over the numbers here. We've got the quarter ended here, 19/20. We got the year ended here, 19/20 here. We see we did about $65.4 billion. That's up 9% over the previous year. I want to show you too that they've already given their 2021 outlook up here. So we're doing about 67 to 68.5 billion dollars. So just up a little slightly, $2 to $3 billion more. But what they also said is the business operating profit's going to be at that 7 to 7.5 range, which seems like a little bit higher, slightly higher margin than what they were doing. They did about $7.1 billion in a segment operating income in this last year. You see here for the quarter, they were up about 14% to $1.875 billion. Now, most of this flows down into the bottom line. They get really nice profit in this company. This is why they can afford this pretty hefty dividend of $10.40 per share. Now, everything looks good from an operating perspective. The balance sheet looks good too. They're not flush with cash. They're not flush with assets. Kind of asset light. I think because this company realizes if they ever get in any kind of trouble, Guess who's going to be there to bail them out? The United States government, aka the taxpayer. They've got $3.16 billion. They got another $2 billion in receivables. They've got these contract assets, which are contracts with governments and things like that, at $9.5 billion. They got about $3.5 billion in inventory for a total of about $20 billion on that current asset side. Now, they do have a long-term debt as well, but it's not much, okay? We were sitting at 11.4 last year or in the beginning of the year, and now we're sitting at 11.7, so up just slightly, but not bad at all. Now, from a cash flow perspective, everything looks solid here as well. We went from 7.3 last year up to $8.1 billion in cash provided by the operating activities over the last year. Investments actually increased quite a bit, up to $2 billion. Here's some other stuff that they're doing shareholder friendly. They've got repurchase of common stock. They did $1.1 billion. They did about $1.2 last year. Dividends paid went from $2.5 billion up to $2.7, and they are repaying this debt as well. All in all, extraordinarily solid company. Already gave you outlook for 2021. I mean, look at this diluted share earnings, $26 per share. And like I said, they're paying you, the shareholder, about half of that, or a little less than half of that, at $10. Now, here's probably even the most exciting thing is over the last couple of years, I'm on a weekly view here for LMT, and we see here the stock dipped underneath this blue line, which is a 50-day moving average, and the stock just rebounded rapidly. I mean, it was down here at $260 per share, and it closed the rally up here at $440 per share. Now, obviously, most stocks made this big, gigantic move in March. Most stocks went below their 50-day moving average, Lockheed Martin included. They went all the way down here back to about $265 per share, but then just snapped right back to $417. Guess where we are again? Below our 50-day moving average. We see this stock does not hang out below this 50-day moving average for very long. This is on a weekly view. Take a look. I'm stretching this out. This is 6 years ago, 7 years ago even now at this time. Way back. I mean, it goes beyond where our moving average can see. Guys, this is a strong buying opportunity, in my opinion, for Lockheed Martin. You're sitting about right here. I know we're touching our 50-day moving average right now, and in my opinion, this would be a buy. Now, if you have fractional share investment and you don't want to go like crazy with this one, sure, get yourself a couple fractional shares. If you want to buy 1 share, 2 shares, whatever it might be, I think this might be, for me, this is like a retirement portfolio kind of a buy and hold type thing. If you want to trade it, by all means, go ahead and do that. It is setting itself up for that potential as well. But for me, this is a nice little buy hold. If you already own Lockheed, I would look to add a share or add to your position now. I would not, I repeat, I would not look to sell down here. Just history does not look like this is a spot to sell. This looks like, in my opinion, a spot to buy. Lockheed Martin looking really strong right now. It's not a stock that I own, but you better believe come Monday, this might be one that I do own. Next company that we're going to take a look at here on the channel is Sony Corporation, ticker symbol SNE. Obviously the makers of the popular Sony PlayStation console. But as we get over to the investor presentation, this is a company with lots of other business units as well. And some of them actually generate a fair amount of income as well. First things first, let's take a look at Sony Corporation from a price to sales basis. This stock is what it would refer to as expensive, at least when it compared to itself. It's trading at about 1.76 times sales. I've got a 10-year price to sales chart up here on Sony Corporation. And you guessed it, that is a 10-year high. Now, obviously, we're on the backs of the Sony PlayStation just being released, and it seems to be doing well. I think when we get over to the numbers here, we'll certainly see that as well. And then we'll jump over the stock chart. One thing that I want to point out here, and if that materializes, could make Sony a better buy than even it is today. Now, we've got Q3 full year 2020 results by segment. We've got this game and network services. Obviously, that's the big one. That includes the PlayStation and all that. Now, that's up huge. Okay, this is in billions of yen. It's up 251 billion yen just over the last year. Okay, we're sitting at 883. That's just a gigantic business. Now, their other big business here is this electronic products and solutions. Here's what I noticed with Sony that was really interesting. So that business on a revenue sales basis is actually down, but take a look. Our operating income actually went up. Here's another example of pictures. So our sales went down 44 billion yen, but our operating income actually went up 16 billion. So they did a nice job in some of these business units where they lost sales, but they were able to gain back some of the revenue. Now, their other one is this financial service segment went up 18 billion and our operating income went up 14 billion. All in all, very strong across the board. You got the consolidated total of 2.7 billion yen. That is $233 billion more than the previous year. Operating income also up about $60 billion to 359. Now, the other thing I want to show you here is they started to give these forecasts as well. So we've got this forecast. This is by segment. And what I noticed is they bumped up their forecast. So they gave you this forecast back in October, and now here they are again in February giving you a similar forecast. Notice that they bumped the gaming and networks up. They bumped that from 2.6 billion up to 2.63 billion. They even bumped up the operating income as well forecast. So it's just showing you they're seeing strength in the marketplace, obviously with their Sony PlayStation, and they're also seeing strength across the board in a lot of things, including this financial services, which is quite a bit up as well. In fact, the most in terms of change in terms of the forecast. So all in all, consolidated total 8.8 billion yen. Okay, that's and 940 billion in operating income. This is also up from their forecast in October. A company like Sony is certainly predicting good days are coming, and guess what's happening in the stock? It is absolutely soaring. Okay, what we've seen here over the last couple trading days is this stock is gapped and then gapped again. Now, if you followed this channel, this is not a chart. This is not a situation that I really like. Now, I'll tell you, I know people, this is all they trade. They trade like these gap ups and momentum. I personally don't like that. I like to see some pullbacks in this one before I'd want to get in. And two obvious spots on this is filling these price gaps. So we're sitting up here at 117. The first pullback would be about 111, maybe even 112 with this one. If it pulls back into that range, you're just dying to get into Sony. That would be the first spot where I would like it. Now, even better than that would be fill actually both these gaps. Fill this gap and then fill this gap and come all the way down to here about $100 per share. You might say that's unlikely, but the stock is sitting at 117. It would be a 17% decline. And when you come over here and look at this stock chart from a really broad perspective, not a lot of declines in the stock by that much, but it's not unheard of, okay? And the stock has pulled forward a ton of gains over the last couple months, and certainly at the last couple days. You could see some profit taking from shareholders in this one, despite the strong, guidance and forecast that they give, obviously with the PlayStation, but along with some of their other business units as well. So I like Sony, okay? I like the PlayStation. This stock's up 65% over the last 5 years. It's up 400%. So, pinching pennies here and talking about a couple bucks here and there may not necessarily be something that you want to do. If you want to inch into this one, kind of buy and hold it, I see no problem with that. We got $146 billion market cap in this one. They enjoy like a duopoly in the console game market, okay? It's Xbox and Sony, and that's it, okay? Yeah, maybe there's some other stuff going on. You got some VR headsets. You've obviously got the iPhone and things like that people play games on. But in terms of console gaming, it is these two companies. Obviously, you've got like PC games as well, but from just a mass market potential, it's Sony and Xbox that hold the pole position, and I don't necessarily see that changing anytime soon, and that should be good for Sony stock and Sony shareholders. Next company we're going to cover here on the channel is Nintendo Corporation, ticker symbol NTDOY. I just recorded Sony, and I probably incorrectly asserted on that one that Sony and Xbox kind of enjoy this duopoly when it comes to gaming. Well, you got to throw Nintendo in there as well. But Nintendo, in my opinion, is kind of like in a league of its own. I almost compare this company with like Disney with their kind of intellectual property and kind of timeless nature of its games and its characters. And it appeals to a wide audience, young and old, whereas my son is probably not going to play a PlayStation for a while, but I could see him jumping on a Nintendo here pretty soon. Now, let's jump into things here. Nintendo, if we want to compare it to Sony, is actually at a much better valuation, at least compared to itself. From a price to sales basis, we're sitting at about 4 times sales. And guess what? That is actually pretty close. It's not that close to a 5-year low, but we're basically on a 5-year average here. Just over the last couple of years, this is about where this company is traded at. So I kind of like it from that perspective. Now, jumping into the numbers. These numbers are incredible. These are in million of yen. So I believe this is like 1 trillion yen. So that's a lot. And so we've got 9 months ended here in 19. We've got 9 months ended here in 20. And take a look at these net sales. Went from 1.0 to 1.4. Hello, that is just incredible. Cost of sales went up just a little bit. So we have this gross profit, which went from 466 all the way in a year, went up to 768. Okay, I mean, it's just incredible. Operating profit here, we went from 262. We like doubled it to 521, doubled operating profit in a year. It's just incredible. So now they've got some non-operating income here. They show they've got this interest income. They've got some other stuff going on. They basically earned another 15, I guess that's about 15 billion in other income. They've got some other expenses here. That gets us to an ordinary profit. I like how they put that. From 273. This is not ordinary. You went from 273, basically doubled it to 528. I think that's 528 billion yen. Just incredible. I know this is not dollars, but I don't care. This could be in napkins, and that would still be quite an increase, okay? Now, I want to show down here is we've got profit before our income taxes. We went from 274, again, more than doubled that, actually, to 530. Now, maybe they should incorporate here in the United States, because take a look at these. Total income taxes came in at 153. That seems pretty high, in my opinion. So we ended up making 376 in profit. The previous year, they made 196. This is impressive. I don't follow Nintendo and even the video game market. I've got 2 young kids. They're not into video games yet. I imagine that I will at some point. But this seems impressive considering Nintendo doesn't necessarily have like a fresh product out there. I know that they have the Nintendo Switch. It's been out there a while and it just continues to sell and sell and sell and sell. And it's just really incredible. So this statement of income is one of the best I've ever seen. I know it's in millions of yen, but just in terms of the growth and the profitability, this company is extraordinarily healthy from that perspective. Now, coming over the stock chart, this stock is actually pretty darn close to a buy, in my opinion. It's not a screaming buy, but I've got a daily chart here, and we can just zoom this out. It's pretty far. Anytime this stock gets underneath this green line, which is right here, this is a 50-day moving average. We got below it here, got below it here, touched it here, got below it here. Well, guess what has happened to the stock? It has rallied, and it's rallied pretty hard in most cases. Sometimes we kind of went sideways, but it's rallied, and now we're sitting here right on the 50-day moving average, almost to the dollar, not quite, but it's sitting right there. Now, we had a nice little pullback into the $72 range. This is about $3 where the stock is right now. This is not a bad spot. If you're dying to get into Nintendo, we're not in a bad spot. It's technically not in a bad spot. Not at a bad spot from a price to earnings, and certainly financially, this is just incredible growth. So I'll give my blessing on Nintendo. Whether or not I jump into this one, I'm not exactly sure, but it is an incredibly well-run company, and they have incredible intellectual property, which I don't think is going to go out of style in any time in the near future. So I like Nintendo. Incredible run. Technically, actually setting up for a buy. If you already own shares, this might be where you add just a little bit more to your war chest of Nintendo. Next company we're going to take a look at is Pfizer, ticker symbol PFE. Obviously, one of the companies that's involved in the vaccine and things like that. Now, over the last year, this stock is actually down 8.5%. They do have a nice yield here, 4%, $1.56 per share. And so what I talked about on the show a little while ago is I was talking about AT&T and Verizon, how I use them kind of as bank account stocks, where I put some money that I might have sitting around in a bank account, and instead of earning 0.05%, I put it in those companies, maybe put a stop loss underneath it and collect a nice yield. And I think one of the commenters on that video actually said that they use Pfizer for that specific reason as well. And so I certainly could see from a dividend yield perspective, and I know the stock's down 8%, but if you were careful where you bought this one, you'd be about even or up certainly on your shares, and you would have collected that 4% dividend. Just something to keep in mind. Now, one thing I do want to say before I jump into this video is there's a reason why we don't really cover a lot of healthcare stocks on this channel. I am just terrible at picking healthcare stocks. I get all my exposure to healthcare basically through ETFs, and that's lesson number one for you guys. I've been investing for over 20 years now, and one of the things that I've learned is figure out what you're bad at and set rules for yourself so you don't keep making the same mistakes again. I went broke in many times. I say broke, I just mean I lost all my money in that specific security buying healthcare stocks numerous times, and so I finally made a rule where I don't invest in these companies unless it's through an ETF. But I still should be able to give you some insight on this one. Now, from a price to earnings basis, price to sales basis over the last 5 years, Pfizer's a little expensive right now at 4.6 to sales. I think it's gotten caught up a little bit into kind of the vaccine. You know, it's rolling that out obviously with Moderna and a couple in Johnson & Johnson and a couple other ones. When we get over to the numbers here, we're going to have the fourth quarter here. We're going to have the full year. I don't know how much vaccine stuff is in here, but this is such a gigantic company. I actually don't think it's going to impact them very much. And so here we see our earnings here, our revenues here, 19 over 20 just for the fourth quarter. And then we've got our full year here as well. This is really just an incredibly stable business because while the vaccine might come in for Pfizer, maybe they got some drugs kind of on their way out and that type of thing, and they're always having to reinvest. This is not like a Moderna where it's like really their only source of income or their primary source of income. Pfizer's just a gigantic company already. We see here in the fourth quarter, we did increase 12%. So if they're able to keep that up into next year, that would be a positive. We see for the full year, we increased our revenues by about 2%. Now, here's the rub. Our cost of sales went up 40%, up from $2 billion up to nearly $3 billion for the full year, went up 5%. Okay, so that's a little bit of a problem. Although we kept our selling, informational, and administrative expenses basically flat for the quarter, they were actually down for the full year. We got research and development fees went way up, about 22%, from 2.7 up to 3.3, and for the full year actually went up 12%. So we see here that despite, increasing sales, it's costing us more on the cost side, and the research and development also cost us more as well. Now they've got some amortization here. They've got some restructuring charges here. These are relatively minor when you factor in how big these numbers are up here. Now, the other thing that I see here on the full year side is last year they had this big gigantic gain on the completion of a consumer healthcare joint venture transaction. So it looks like they made about $8 billion last year. That ballooned their net income last year to $16 billion. This year it's at $9 billion. And you might say, wow, that's down. Yeah, it's down 41%, but it's primarily, you take this $8 billion off of this 16, and then you get to a number that's very close to this year. And in fact, a little bit lower. So they actually increase their net income if you subtract this big gigantic kind of gain that they had last year. Now, for the quarter, they went from a 337 net loss in the fourth quarter of last year to a nice $594 million. Now, here's the deal, though. In the net income in this quarter, we made 11 cents per share. I showed you that they pay $1.56 per share. So they better, have some good quarters, and I can imagine they probably will. Now, we see for the net income for the whole year, we made $1.73, but again, we pay $1.56 to shareholders. Not saying that this dividend's in any kind of financial insecurity, but it's just something to keep in mind that this, despite all the hype and stuff around, I mean, most of these articles and stuff talk about this vaccine, but when you jump over the numbers here, there's not really evidence that this is really doing a whole lot for the company, at least at the current time. I know it's just rolling out and it's still kind of in its early stages, but there are other companies out there kind of doing the same thing. Now, from the stock chart perspective, it really screams one thing at me when I've got a daily view here. Excuse me, this is a weekly view of Pfizer. This is going back to 2015. What this screams to me is you want to buy Pfizer when it's well below its kind of moving average here. We've got this green line, it's its moving average. We see numerous times this stock, I mean, many times, this stock has traded well below its 50-day moving average. My opinion, that's when you want to step in and get it. Now, right now, we're sitting right smack dab on it, which could be, you could make the argument, hey, it's going to bounce there, and it's going to, but personally, I would wait to see if you get a deeper pullback in this one, because like I said, over the last 5 years, you had 1, 2, 3, 4, 5, at least, it looks like at least once per year, you're getting a shot at this one at a lower price. And obviously we're touching the 50-day moving average right now. Yes, it certainly could bounce there, and it could be a buy in that situation. And I would trust your instincts on this one. But for me personally, if I were looking at this one kind of from an unbiased lens, I'd say, hey, I want to pick this one up on a much deeper pullback. Obviously a harder thing to do. The story, the momentum will have completely changed by then. You really got to have balls of titanium to kind of step in here when a stock is well below its moving average. The news will have turned negative as well, typically on these types of stock, and maybe on the broader market as well. But that's where I would want to step in on this one, because as you can, again, you can see over the last year, this stock is down about 8%. And even over the last 5 years, it's up 20%. I hate to say only 20%, but this market has just been ripping. Okay. And so a lot of stocks are up hundreds of percent. Even big gigantic companies like Apple and Nike and Amazon and those types of stocks are up huge over the last 5 years. And so you want to be judicious about, if you're going to invest in Pfizer, be careful about your pricing. Be careful about when you step in on this one, because it is not a massive mover, okay? And so you do want to be careful where you're stepping in on this one. So I just want to emphasize those points. Hopefully they help you out with Pfizer. And folks, that wraps it up on this one. If you have any suggestions for stocks that you would like for me to cover, either in this format or in the individual format that we typically do with the other stocks, leave me a comment down below. I'd love to hear from you. Thanks for tuning in today. Good luck with your investments.